This is the 2016 Doherty Limited Interpretation of Accounts. We're just looking at Part B here. I'm going to quickly go through a lot of this in terms of the answers, and then I'm going to kind of talk a little bit more as if I was in a classroom situation and kind of a little bit more background and education on what we do talk about for these kinds of questions rather than just read out answers. Again, for this question, we were asked it from the viewpoint of an ordinary shareholder, just like the 2019 question. But unlike the 2019 question, where we were asked specifically for a structure, this is the 2019, we were asked for the performance, state of affairs, and prospects. This time, we're just asked, would we be interested in purchasing more shares? So you're kind of basically trying to just say the same thing. You don't have to give the three headings. Performance and so on down here, but the idea is that you still talk about the shareholder's perspective, and you try to add in here and there. This is good, for shareholders, in terms of would you be interested in buying more shares or not, and that would come in both the performance, state of affairs, and prospects sections. But again, you don't have to divide it up into sections here. First one, profitability, we can just see that, again, final thing to add here, I'm not going to go through these ratios. If I did that, it would turn into a 30-minute video. All the formulas are up here at the top, and we've covered them for many questions so far, and I have videos up on there. I'm going to call out the answers if you got them wrong. Obviously, the idea is that you go back, check your numbers, and see where you made a mistake. ROC is improved from 10% to 12%, so the profitable above the risk-free rate of 2%, and the cost of borrowing is 6%. Again, where do we see the cost of borrowing? It's the debenture percentage rate here. So that's the cost of borrowing, because that's what's going to cost them interest-wise to borrow even more. So that's the cost of borrowing. The return from risk-free investment is now actually 1 to 2%. It was back in 2016, it was more along the lines of 2%. I've taken this marking scheme from 2016 and I've changed a couple of things. So the companies making efficient use of resources, of course they are. Their profit is up to 12, nearly 13%. Shareholders are obviously going to be pleased with that. If the upward trend continues, the debentures can be paid in 2017 without having to sell the secured assets. You wouldn't even need to add that in. You just basically need to say that the shareholders will be very pleased with the upward trend, and obviously hope to continue that along into the future. Dividends. Dividends are important for ordinary shareholders. I can't stress that enough. For ordinary shareholders, this part is important. Give as much information as you can. Three formulas from an ordinary shareholder's perspective. We have dividend per share, dividend yield, and dividend cover. You don't have to say too much on the three. I'm showing you that the dividend per share has gone up. I told you that dividend yield has also improved. This again is above the return from risk-free investment of 2%. Being at 5.6%, it's the return they can get from their dividends. So as an investor, I can actually get a good bit more money by investing in this company and getting a 5.6% return, compared to if I was just to invest in a non-risk company where I usually get 2%, 1 to 2% returns, but 1.4 at the moment. The dividend cover has also improved from 2.2 times to 3.37 times. I'm going to go through something here. While the shareholders will be happy with these improving trends, they will feel that the company has scope to pay a higher proportion of profits in dividends. Alternatively, they could be pleased that profits and cash are retained for the purpose of repaying debenture holders and expansion. What does all that mean? Well, dividend cover actually, unlike most formulas, if I tell you the return on capital employed has increased, you know it's always good. But from a dividend perspective, sometimes it can be good, and sometimes we think, oh, I don't think this is, I think this could highlight a few problems. So I'm going to go through what I'm talking about here. Dividend cover was 2.2, now it's 3.37. Okay, so hypothetical situation here. Let's say we have a company and they're making profit of 100,000 and they're paying out dividends of 20,000. If I quickly go back to my dividend cover formula here, I can see that the formula itself is net profit minus preference dividend divided by total dividend minus preference dividend. You don't always have that preference dividend, so just for the sake of simplicity, I'm going to ignore it here. We're just looking at the company's profit of 100,000. They pay 20,000 out to their shareholders as a dividend in the form of a thank you for investing in our company. So dividend cover here would be our profit divided by our dividends, and it would be equal to 5 times. Essentially, I'm able to pay my dividends 5 times over with the profit I have. So that's how that works, and that's kind of what that means. So we tend to say that anything above 2 times here is good. We don't want it to be below 2 times. If this was below 2 times, let's say I pay out 60,000 dividends for my 100,000 profit. Now it's below 2 times, and I'm starting to wonder here. Okay, this is only going to cover 40 something percent in terms of the what I have left after my 40% of profits I've left after dividends. Maybe that's not enough. In that 40,000, I have to pay back my debentures. I have to pay back, other forms of interest I may have. Maybe this isn't enough profits that the company is keeping. So if the company makes 100,000 profit, you're going to want to say, okay, this profit can be used for the future, maybe to pay back loans or to invest more in the company. But if most of that profit is going to dividends, if a high percentage is going to dividends, the company might struggle to progress on next year. So that's why we don't want it to be too low. If it was at the 2 times recommended, I'd be able to cover the dividends 2 times, and we'd still have half of our profits left to invest in the company. So we kind of don't want to invest anything above half of our profits. So at the moment it's 20,000. Now the ideal ratio here for the 2016 question, sorry, the given ratio here we worked out to be 3.37 times, and we're saying we'll be happy, but we feel like they have scope to pay a higher proportion of profits and dividends. And this is what this means. So the last ratio was what, 3.37, so I'm just going to say 33,333, as I know that's about a third, so we're talking we can pay back 3 times our dividend cover here. So ideal ratio is 2. Now my ratio here is 3. I can pay this back 3 times. I have a good bit of money left. The company is probably some bit happy, but as it goes beyond this, as it goes above 3 times, and now we're looking at 4 times or 5 times, the ordinary shareholders are starting to wonder, how come the company isn't paying us more dividends? Why aren't they paying? They've made 100,000 profit. They're only giving us back 20,000. What are they doing with the other 80,000? So that's why the dividend cover here is 5 times, and if it's above the 2-time minimum, I'm thinking, oh, this is good here. The company isn't struggling to pay the dividend. But after a while, once it gets to a certain amount, I mean, let's just say this is an extreme example. Let's just say the dividends are only 2,000. They can cover these dividends 50 times. I'm beginning to wonder, why aren't they paying more? I'm investing in this company. I'm a shareholder, and they're only paying me back 2% of their profits. So you kind of be, you'd be wondering, okay, why isn't this company looking after their shareholders? So dividend cover here, just because it's above 2 times, doesn't make it better and better and better. As we start to go above 3 times, sometimes you can start to include here the company has a higher scope to pay more proportions of their profits in dividends. I'm going a little off track here, and obviously it's not a classroom situation, but I still want to kind of discuss a little bit more on some of these and what they mean. So 2 times here is the minimum amount we want. As it goes above 3, you can start adding this in. The company's wondering, wait, why haven't I getting a little bit more cash here? The alternatively, they could be pleased the profits and cash are retained for the purpose of repaying debentures. So if you had very high debentures, if this was up to 600,000 and half of your company was financed by debentures, you'd be worried about, oh God, I got to pay back a big loan. Maybe the company should keep a lot of the profits, and they shouldn't be paying as much dividends, otherwise they'll struggle. But here we can see the debentures isn't going to be that high. We'll see that later on with gearing. Again, sorry, this may be a little bit too much in terms of trying to understand this at home right now, but we will be going through this again and again and again with different questions. So after a while, you will kind of get used to the lingo and what I'm talking about. The liquidity, the quick ratio, again, I'm skipping over the formula, but it's gone from 1.2 last year to 1.63, which is good. For this one here, the minimum ideal ratio is 1:1. So the current assets minus closing stock is to current liabilities. We want to be able to pay back our current liabilities. We want our current assets minus closing stock, the money that we're expecting to get in the short term. We want it to be a good bit higher than our current liabilities. If our current liabilities is higher and this was 2, this would be a struggle. Our current liabilities are now really high. We owe a lot of money in the short term. And we wouldn't have much current assets, so we wouldn't have much money coming in potentially from debtors or investment income due or something like that. So that's why you want that figure to be as high as possible on the left. You want the ratio to be high here. So they should have no problem in paying short-term debts when they fall due. There is a €0.63 available in liquid assets, so these are short-term assets. There's a €0.63 available in liquid assets for every euro owed in the short term. These are my euros owed in the short term, my creditors falling due within 1 year. Shareholders will be pleased with this as there is a good ability to pay dividend and interest as well as having funds available for investment. If a company has a good ratio here above 1:1, generally they probably have a little bit more cash lying around, and that's when you see them starting to invest in dividends. They're not struggling to pay interest. The company is doing well. If the company was doing bad here and the ratio was 1:2, you'd expect the dividends here to all have gone down. Everything would be struggling for money. So that's just basic kind of quick thing there on liquidity. The market value of a share, it's improved again. This current year we didn't have to work it out. So this is improved again by 10 cents. It's whatever 6, 7, 8% increase. This indicates market confidence in the company, which will please shareholders. So the other one here is the price earnings ratio has fallen from 8.7 years to 5.3 years. This will please, again, we want this ratio to be going down as much as possible because it takes a shorter period of time for an ordinary shareholder to recover his or her investment in one share. Price earnings ratio from last year I don't think was given, so it wasn't given here. We know our earnings per share last year, and we know our market value per one ordinary share. So we can see that in the formula here that my price earnings ratio here is going to be my share price divided by earnings per share. So I have both of that information. I can work out my PE ratio from last year. That's where I got this figure here, the 1:1 euro and 15 cent. So again, it's fallen the last year, which is a good thing for this formula. And again, the shareholders are going to be happy with this. The gearing, quickly again, although it's somewhat important, it's not very, very important for an ordinary shareholder. So we don't need to comment on it much. The gearing is, unless it was really bad. The gearing is improved from 54% to 44.33%. Everything above 50% is considered highly geared. Everything below 50% is seen as lowly geared, and we want to be lowly geared. Basically, this formula is gotten by comparing my total debt to my equity, which is the money I finance my company with. So my total debt here being my debentures and my preference shares, money that I will have to pay back. Preference shares is 300,000. My debentures is 200,000. Compared to the total amount of my company, which is over $1 million, I have less than half of it being financed by debt, which is a good thing. If over half of your company is financed by debt, that's when you start to see highly geared. That's bad because obviously the company's worth is been inflated by debt, which they have to pay back, and that's an issue. So you'd be dependent on outside borrowing, but we're not here. The interest cover has improved from 6 times last year to 12 times this year. We're able to cover the interest 12 times over, which is obviously really good. We're not going to struggle to pay interest back. The sector, if you have seen the marking scheme from the 2016 paper, the sector comments from that paper will have been relevant to that time, 2016. So the sector in question here, you always see it at the top, is the service provider in the tourist industry. So this Doherty Limited are in the tourist industry. The spiel that the marketing scheme had from 2016 was painting a really good picture. But if you are awake and paying attention to the world around you currently, the tourist sector is taking an absolutely dreadful hit at the moment. There is nobody in the tourist sector that's really doing anything in terms of making money. So if you were to sit the exam this year, your exam is going to be your comments are going to be very different. In fact, for the next couple of years, I'd imagine things won't be too great for tourist sector compared to the previous couple of years. So this is just what I put together here. This is what I would say if a student was sitting this summer, or probably next summer as well. The company is in the tourist sector. The industry is struggling at the moment as the tourist sector has taken a massive hit due to the social constraints put in place due to the COVID disease. As economies around the world are struggling, people have less disposable income to spend on holidays. Basically, obviously, people have less income. If you have less income, you start to only spend money on the things you need, and you kind of forgo your holidays to the Caribbean and so forth. So there'll probably be less people coming to Ireland over the next couple of years if the economy takes a big hit around the world. The weakness of the sterling against the euro has also made Ireland a more expensive destination for visitors from the UK. I don't expect you to be able to understand or pick this up or to know much about it at the moment. We can go through this again in time. This doesn't change too often. At the moment, all you need to know is that the sterling is doing bad because of Brexit and there's uncertainty in the UK. It was a lot better for the English to come to Ireland a couple of years ago. Now it's a little bit more expensive for them, as if they will go to the bank to change their sterling to euros, they'll get less euros now, meaning they have less money to spend. So perhaps they may want to holiday in the UK more than coming to Ireland now. The UK being a big source of income for our tourist industry, anytime the sterling kind of drops in value, it's seen as a bad thing for the Irish tourism industry. That's my little kind of explanation on that. The future prospects appear bleak as the world will struggle economically and the industry could take a hit just like the years after the 2008 financial crash. The tourist industry is going to struggle probably a bit because not to paint negative Nancy here, but obviously there'll be a little bit of a recession after the COVID-19 disaster. As you can see here, this is very negative, but that's what they will expect this summer and probably next summer. The rest of the question is very positive. If this question was set today, we know that the tourism industry would be struggling, so they probably would have changed all the figures here so that all of this would have been, kind of struggling. The company wouldn't be doing great, and then you could say the sector isn't doing great too. So I'm going to say here, overall shareholders would be happy with this, and I would buy more shares in the company. But that's because in 2016, all of these were painted to be kind of great. The company was doing great, the sector was great, whereas from this summer and next summer, if you were to see this question come up, the sector is struggling, so they'll probably change all of these to have these struggling as well. I don't think many people are going to invest in the tourism industry right now, so I wouldn't be recommending anyone to buy shares in that industry. But for the sake of this question, because all of this stuff is positive, because this was set in 2016, this would have also been positive, so you would have stated that you would be happy to purchase more shares. That's just kind of my brief explanation of the 2016 question. As you can see, a lot of it is quite similar to the 2019 one. There are certain changes I've just seen just from even the marketing scheme. They're saying different things here, like if the upward trend continues, interest can be paid. As long as you have some form of a summary that's relevant to shareholders and will they be happy, generally you kind of will do some bit well. If anything, I'll add in more kind of sentences like this that we haven't seen before, so that you kind of have more of an arsenal of stuff to say, and you've seen more stuff, you've seen more comments across different questions. So this isn't going to be the same. You can't just throw in the same lines for every question. We're doing shareholders now. The next time we move on to bank managers, like this spiel is going to be a little bit different. But the focus here is just by learning by doing these questions more than anything at the moment. We'll get as much work as we can done through remote learning of ratios. And obviously this is going to be something you will spend a little bit of time with again in 6th year, because it is an important question. So don't worry about whether you feel like you're not learning as much from it being done through online. However, the ratios is just a case of doing them over and over and over and going to the bother of learning off these 20, which is a necessity. And for this, it's just the more you do this, it starts to get a little bit more snappy, and you'll pick up on what's going on.